Welcome to Understanding Credit Scores and Understanding Credit Simulations and How to Improve Credit. But first of all, let's just talk about credit. Credit scores are kind of, I like to put it like DNA, and everybody has different scores and everybody has DNA. My name is Victor Bales. I'm a licensed loan officer, NMLS number 162273, and I kind of want to go through and talk about credit scores and how to improve them. Because if you didn't know, credit scores have a big effect on your interest rate when getting a mortgage and your closing cost. If you're above a 740 credit score, you generally get the lowest cost and the lowest interest rates. However, once you fall below 740, credit scores usually price out in the 20-point buckets. So between 720 and 740, you get one rate. 700 to 720, it's a higher rate. 680 to 700, it's a higher rate. 660 to 680, even a higher rate. However, government mortgages, such as VA, rural development, FHA, their credit score requirements are, I guess, not so discriminative. Basically, if you have over a 640 credit score, you get the same interest rate as someone with the 740 credit score. But depending on the mortgage type or depending on life, credit scores are very important because a lot of homeowners insurance, credit card interest rates, automobiles, all base their interest rates off of credit scores. So I want to simulate some stuff with you and share a screen with you, just so you kind of understand what credit scores are doing. So I pulled up a recent credit report that I had, and this particular individual only has 3 credit cards on here. And you can see that by revolving credit, revolving credit, and revolving credit. But I want you to make note over here that this is an authorized user account. So this could be a sibling, a spouse, or somebody that put this individual on there as an authorized user. But I want you to pay attention to credit utilization. Now, on this particular credit card right here, they have a $1,000 limit, and they're at $678 balance. So they're at 68% utilization. And on this credit card, about a 60% utilization. And on this credit card, about a 41% utilization. And so if we want to optimize credit scores, what I want to do is just show you what happens if we take some actions. Let's say we paid this credit card off to, let's say, $400. So what happens now? You go up to a 703. So we've hit that $700 marker. But let's say we paid it off completely. Okay, and we went down to a 0 balance. Okay, 710. Well, let's say we paid off this credit card here down to a 0 balance, a 733, and we pay this credit card off to a 0 balance. Now we go up to a 754. But let's look at this authorized user. Let's say the authorized person actually puts a $50 balance on there. What happens to that score? $50, $50. It's still a 754 score. So in this particular situation, to maximize scores, we want to pay off these 2 credit cards. But let's say we don't have the money to pay off those credit cards. And let's say we only had, let's just pay this one down to 0. Okay, it goes up to a 710. And let's say on this one here, we don't have $400 more. But if you look here, we're at a 41% utilization. Now, you've never been late on this credit card, because if you were late, it would be reporting here. But let's just say you called the credit card company and you said, you know what, can you raise my limit to not $1,000, but $2,000? Now look at that. We already went up to 723, and our utilization went down from 41% down to 20%. So that's a tool you can use as well. But I want to show you how a late payment can affect you. So if on this Capital One credit card, you were 30 days late, your score would go from 690 down to 597. You're going to lose about 90 points. So don't ever be late on a credit card, because it takes a very, very long time. And if you were late on a credit card and we looked at 1 year from now, you would only be up to a 619. And if we looked up at 2 years now, you'd be at a 637. So you never want to show a late payment. Okay. Now, what would happen if a credit card actually went into collection? You drop down to a 645. And if this one went into collection as well, right here, 636. So it's going to drop your scores. Now, another thing you want to definitely look out for is, how you utilize credit there. It's definitely about the balances versus the limits, but don't just listen to anybody stating you should pay off your credit cards, you should close out your credit cards. Your particular situation may be much different. So when you're going to obtain a mortgage and you discuss with your lender and they pull your credit score, you always want to talk to your lender to say, is there a potential where I can improve my credit for one, to get a better interest rate, or possibly two, to get out of or convert from an FHA or a government mortgage over to a conventional mortgage? Because on the government mortgages, you will have that PMI, private mortgage insurance, for basically the life of the loan, versus a VA mortgage, which is a great mortgage. You don't have any PMI at all. But a conventional loan, if you can get up to a 700 or plus is where I recommend, you will have PMI insurance in there, but you don't pay any government funding fees, and that PMI will go over or go away after a particular amount of time. Once you have 3, 5, 10, 15% equity, and ultimately when you have 20%, it'll go away. So work with your lender, have them run credit simulations. We want to optimize credit scores because it's very important. This could save you tens of thousands of dollars in interest, and maybe it could stop you from having to refinance later, which could cost you a lot of money as well. So I hope you've enjoyed this tutorial. If you have any questions, you can always email us here at info@assistmyrealtor.com. Thank you.